Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video we're going to talk about exiting options trades automatically. So as we discussed in the last video, trade entry is an important aspect of successful trading, and probably more important obviously than making adjustments to trades. Now, in our opinion, all of your analysis or thought should go into placing smarter trades from the start, and that's really where we focus a lot of our attention here at Option Alpha. Therefore, the easiest part of trading actually should be the exit. It shouldn't be complicated, and it needs to be automated as much as possible to help remove your emotions. That's the way that we believe you should be trading, meaning a lot of your thought process, your analysis, entering the right trade. Once you're in the right trade, the exiting part should be pretty much automated and non-emotional as much as possible. So here at Option Alpha, we favor placing a GTC or good till canceled closing order immediately following each and every new position that you enter. Again, we've outlined the specific profit targets in a simple PDF guide that we have right here in the membership area. And I just want to kind of cover some of these right now so that you can understand how this works. So this is what you'll see as you download the PDF guide. Again, it's completely free. You can take it with you. It's kind of like your checklist for how you should be using automatic exits and stop losses, etc. And you can see here that for bullish trades, let's say we were doing a bullish call debit spread, okay? We'd want to take that trade off at 50% of max profit. So that means that if we enter that trade, let's say for $1, and we can make $1 on the trade, then we want to take that trade off once the trade increases in value to $1.50. So we entered it for $1, we can make $1 or lose $1. That means our max potential profit is $1. We want to take that trade off once the value goes up half of that max potential profit, or up to $1.50. And again, we'll go through some examples here so you can understand that. And again, what we usually try to do here is make sure that we're maximizing both the number of wins that we have, that's why we're trying to do this, and the potential money that we make. You can see some trades, obviously, we're going to be a little bit more aggressive in how we take profits. So like a put broken wing butterfly, we're going to be a little bit more aggressive, wait a little bit longer for a bigger profit. If we do a custom naked put or something like that, or a single naked option, we'll again wait for that 50% profit target. If we're doing things like calendars and diagonal spreads, we're actually going to take profits a little sooner because those trades don't have as good of a success rate on the outside, meaning when you enter a calendar spread or a diagonal spread, you don't have the really, really high probability of success that you have with credit spread or an iron condor or something like that. So you want to take those profits off just a little bit earlier. Again, we've also got guidelines on neutral trades. So most of the neutral trading that we do, we take profits at 50% of max profit, except for things like straddles and iron butterflies. You're going to be a little bit more aggressive when you enter a straddle or an iron butterfly. You're going to take in a bigger credit. Therefore, you can actually afford to take it off a little bit quicker, meaning at a very short or very quick profit target of 25%. So again, this can help you and guide you as to where you need to exit these trades. And again, this is based on a lot of data and research. So we also have bearish trades. Again, I won't go through this one, but very similar to the bullish trades. But pretty much any strategy that you want to trade, we've got guidelines on how you should be exiting those trades. So the question becomes, why would we want to exit trades early? I mean, we've kind of covered it, but again, the two biggest reasons why we want to exit trades early are to, one, increase our win rate and profits, and number two, reduces our trade duration and exposure. So when we exit a trade early, that means that we are locking in a gain for sure on a trade that could have gone the other way, right? So like if you have a trade and it goes in your direction early in the cycle, or maybe right after you enter the trade, why not take that trade off, bank the profit, and prevent an opportunity to hold on to the trade where it could turn around at the end of the expiration cycle and go against you. So once you do that, you'll see that you'll actually increase your win rate, and it will increase your overall profits. So even though you'll be taking less money on each trade than you actually enter for a credit, you'll actually have a much higher profit at the end of the day because your win rate is going to be dramatically higher. And again, we'll kind of prove this concept with what we do here at Option Alpha. The second part of this, obviously, is it reduces trade duration and exposure. So if we enter a trade, let's say 45 days out, but close it after 10 days, we only had money exposed for 10 days. We didn't have money exposed for 45 days. Now, does this always happen where we get to close out a trade 10 days early or 10 days into the cycle? No, sometimes we do have to wait and hold the trades all the way to expiration. But most of the time, we are not in trades more than 30 days. In fact, right now, as it kind of sits at the time I'm doing this video, our average trade duration across all of our trades is about 27 days. So that means less than 30 days we actually have money invested into the market. Most of our trades are actually placed anywhere between 45 and 60 days out. So we're closing trades at about half the time right now. And again, that reduces our exposure and the amount of money that we have at risk in the market. So for example, let's assume on the next chart, just to kind of prove this point here about why you should be closing out trades early, that you sold the same 43 calls and 40 puts to create a strangle 3 months in a row. This is strangle, not strange. So you created a strangle 3 months in a row, back to back to back, okay? Now this is a chart, I believe, of AAL at the time that we were actually doing this video. It doesn't really matter, but it proves the concept. So again, let's assume that the 43 calls are here. This is your line in the sand, or your break-even point on the 43 calls. And then you sold the 40 puts down here below the market as well, okay? Now each of these red lines on the chart here is an expiration date. So for just the sake of argument here, we'll assume that you entered a trade at the beginning of expiration, and it was just a 1 month trade, which means that it expires the next expiration month. And then you entered another trade here at the next expiration. You entered another trade here at the next expiration, etc., etc., etc. Okay, so we just assume that you just keep entering this same 43-40 strangle back to back to back. Now, if you entered the trade here at the X point, you had a lot of opportunity, because again, you want the stock to trade inside of your range. You had a lot of opportunity to close out this trade early in the cycle. Yes, there was a lot of movement, but likely as you got through that initial cycle, you saw some time decay, maybe a drop in volatility, whatever the case is, but you definitely saw the value of the options probably go down because the stock more or less traded sideways for about 20 days. Now, if you had taken profits early, you would have been out of the trade somewhere around here. Maybe 20 days in or so, you would have taken profits early, been out of the trade. If you waited all the way until expiration, tried to kind of milk every last penny out of this trade, you might have been stuck in a situation where the stock broke out above your strike prices. Okay, it came back in on the last day of expiration, but it actually closed outside of your strike prices the last day of expiration. Okay, so this kind of proves the concept that at least in this first month, you had a lot of opportunity early in the expiration cycle to take money off the table. Probably multiple times you could have taken money off the table. Had you waited and been maybe a little bit greedy trying to get every last penny out of it, you would have either been faced with two scenarios where the stock would have gone against you and maybe you would have used a stop loss order or something and it would have hit you out of the trade and not had a profit. Let's assume that the next month comes and the stock opens lower, but you continue to make that same trade. So you place the trade on this date. And again, it probably took a couple days this time for the trade to come into a profitable range. Notice that the next expiration cycle that we're trading here, so the second month, it took almost 8 or 9 days for the stock to come back inside of your 43 call, 40 put range. But once it did, you had a couple days, you had a window of opportunity here to take money off the table again. So early exit in this case actually ended up being the best opportunity to make money in this trade, because had you waited until expiration, which again in this expiration cycle is this line right here, the stock actually closed outside of our potential profit zone, closed up around $44, and would have been a losing trade, again, if you had waited all the way until expiration. So the person who closed out the trade early in the middle of the cycle, even though they banked potentially a little bit less money than they could have made if they had made a complete profit, they actually made money versus this person who did not make money by holding it all the way to expiration, okay? Same thing, so we go to the next month, and again, just kind of proves this concept. Let's say you enter a trade on this date. So the next expiration cycle, you enter a trade the first day of expiration of the new month or calendar month, and you can see that the stock comes into your range early, but maybe you miss an opportunity to get out of it. Okay, so for whatever reason, the pricing wasn't there, you didn't reach your 50% profit target, whatever the reason is, but it came into your range early, but it just wasn't a good exit or didn't hit our profit targets that early in the cycle. Well, we did get another opportunity later on in the cycle, maybe towards the back half of the expiration cycle, again, maybe 20 days into it. We got an opportunity here where the stock closed right in the middle of our range about 20 days into the trading month. So we could have, again, closed out this trade at a profit. By this time, there's probably enough time decay and volatility decay in the value of the options to actually take a profit off the table. And again, if you had done this and taken the profit, you would have avoided a scenario where the stock actually closed much higher than our break-even points, again, creating a loss at expiration. So as you continue to see this play out, it happened again the next month, and most stocks, it happens all the time. But the reality is that you have to understand is that as a trader, you cannot really dictate where the market goes, but you can be a little bit opportunistic in the way that you take money off the table. So whenever the market is favorable and reaches a profit target early or decays in value early, you have to be diligent in taking money off the table. Now, the challenge that most traders fall into is that they don't have the emotional competence to actually do that, myself included. Sometimes we see a trade come into our range and we think, oh, okay, now it's going to, stay in this range until expiration. I'm going to, keep the entire profit that I'm really looking to get. But the reality is that sometimes the, stocks make big moves, and right before expiration, they make huge moves that either turn them into full losers or maybe a winner into a loser, whatever the case is. We have to automate this process so that we remove ourselves as emotional traders and investors from the process, so that whenever it happens in that expiration cycle or that month, we're out of the trade immediately. Another reason why I like to do this is because then I don't have to watch and manage my positions throughout the month. So if we're keeping our position size in check, or since we're keeping our position size in check, we can hold these trades until our profit target is reached. And that's what I like about these automatic closing orders, is that I know that that order is always working for me. I don't have to constantly go in and monitor these trades to get them off. I'll just get an email alert that says the trade's been, taken off at a profit, and I know I'm out of that trade. I can focus on what's more important, which is finding new entries and new trades. So again, sometimes this will happen early in the cycle, meaning you'll get taken out for a profit early. Other times you might have to hold, 20, 25 days into the cycle or all the way until expiration before something turns around. For going back to this chart here, you can see that if we traded another strangle, that same strangle the last month here or the fourth month, the trade really didn't turn out to be a profitable trade until the last 4 or 5 days of expiration. So you had to wait a long time for this trade to come back in. Now, this isn't saying that we would, obviously sell a strangle like this if the market was higher. We would obviously adjust the strike prices, but I'm just trying to prove the concept that sometimes it takes a little bit longer for trades to come in. Sometimes it happens early, sometimes it happens later in the expiration cycle. So the reality is that it's not unreasonable to increase your win rate by as much as 10% or more by closing trades early and taking profits. Meaning a 70% probability trade would actually see 80% winners if profits were taken early and the trade was closed out. In fact, actually, we can kind of prove this concept because we publish our performance and live stats all the time on Option Alpha, and our 3 core strategies, just to give you a sample of this right now, our 3 core strategies, which are strangles, straddles, and credit spreads, all option selling strategies, win at 84%, 82%, and 78%. Now, if you think about it, all of the trading that we do here at Option Alpha is placed at the 70% probability of success level. So the fact that we're winning at 84% is just meaning that we're taking trades off so much, so early that we're actually winning at about a 14% higher win rate with our strangles, about a 12% higher win rate with our straddles, and an 8% higher win rate with our credit spreads by managing these trades early and banking these profits early. And that's really, again, why we kind of place trades around 70% chance of success, because we know we can win about 84% of the time. If we ended up placing trades around the 80% chance of success level, we might end up winning about 85 or 90% of the time. But in our opinion, it's not worth giving up so much premium to go that high for an initial probability of success level. But again, this kind of proves the concept that we're talking about here, that, when we actually go back and track all of our trades and publish them live in our performance stats, we definitely see that our win rate is much, much higher than the initial probability level that we're covering. So let's actually go through a couple examples from current trades that we have on right now so that I can show you how we set up these automatic closing trades, because I think it's really important. And again, this is based on what we have right now at the time that I'm doing this video. So this is about as real as we can get. I've basically taken off a couple of the working orders that we have just so I can rebuild them here for you guys and kind of work through the process. So let's actually start here with some call debit spreads that we have. These are directionally bullish trades. So these are where we were being a couple net buyers of options, trying to play a couple of these ETFs a little bit higher. So if we go back to our slides here, you can see that if we're doing a call debit spreads, which is a bullish trade, we want to take these trades off at 50% of max potential profit. So now going back to our Thinkorswim platform, let's look at the first one here, which is EEM. Now EEM we actually bought for a $55 debit. The width of the strikes here is $1, so the max potential gain that we could have on this trade is $45. So half of that, so again, 50% of that max potential gain, or half of that max potential gain, would be a profit of about $22.50, right? So let's just round it down to $22. So what we're going to do is we're going to add $22 to the value of the contracts that we bought, because that's what we want to do. We want to increase the value of this contract and hopefully take it off at a 50% of max profit gain. So if we go here and right click on create closing order to sell back these verticals in EEM, it's going to bring up this order dialog box. And what we're going to do is we're going to create this contingency order that says, okay, basically buy these back at $72. Okay, so we're going to add that $22 to the $55 that we had originally, and we're going to buy this back at $72. Now remember, maximum value of this spread, if it went all the way to expiration and was totally profitable, is $100. That's the width of the strikes here. So we're going to try to take it off early whenever it reaches a $72 value. And again, we're just going to put that $72 in here. And now what we're going to change is, instead of doing a date order, we're going to say GTC. And what GTC means is that it's going to be good until canceled, meaning this order is going to work and it's going to try to get this trade off at $72 until it gets filled or we hit expiration. And that's all we want to do. We want to let this trade work as long as humanly possible. So I went ahead and placed this order. I'm going to hit send. And so that order will now be working in the market. And now you can see in our order dialog box up here that we have our closing order. It's a GTC order, very similar to some of our other trades and orders right here. It's a GTC order that's going to get us out at $72 whenever the value goes up to that price point. And so right now the mark is at 55, which is almost where we paid for, what we paid for the value of the spread. But it's just going to keep working. So as long as this order keeps working for the next basically 50 days, whenever we have an opportunity to take money off the table, this order will automatically get us out. I don't really have to think about this trade anymore because I know I've already controlled my position size. I know that I'm willing to lose, about $150 on this trade if it doesn't work out. But it should hopefully, hit that profit target. So again, let's look at another one here with FXI. So FXI is another call debit spread that we're trading. And you can see that we paid for FXI $1.05. So we paid $1.05. Now this is a $2 wide spread, so it's going to be a little bit different. In this case, our max potential gain on this trade is $95 because that's the value of the spread. The spread's going to be worth $2 at expiration, meaning that we can only make $95 on this trade if it were to go all the way to expiration and be profitable. So half of that $95 is basically $47.50. And again, we'll just round down. You don't have to be exact with, $47.50, but let's just say we want to add $47 of value to this contract. So if the contract starts at 105, we add the $47 value. We're looking to close this trade when the value of this contract goes up to 152. All right. So what we're going to do is we're going to do the same thing we did with EEM. We're going to right click here, create a closing order, and we're going to say sell. And now we're going to adjust this price to 152, which is our profit target on FXI. And again, we're going to change the type of order from day order to GTC. So I hit confirm and send, submit the order in. Now in my order dialog box, my working orders, you can see the two orders that I have now created here. These are going to constantly work until they get filled or until we reach expiration. Okay, and we'll just keep working through that. So let's go through a different one here. So let's look at this calendar spread in SPY. So we're trading a calendar spread in SPY. We're using a put calendar spread. So we've got the May 200 puts and we've got the April 200 puts. If we go back to our slides, since we're doing a put calendar spread, you can see that's a bearish trade and our put calendar spread needs to be exited at a 25% gain of the net cost that we got to get into the trade. So a 25% gain means we're going to take profits a little bit sooner. So once the value of the option goes up by 25%. So all we want to do in this case is look at the value of the option that we paid. So this is $195, and we want to increase the value of that option by 25%. So if we take $195 and increase it by 25%, we're looking at closing out this trade at a profit, or whenever the value of this spread goes up to 243. So that's, again, rounding down here, not using exact numbers. It's 243.75. But if we want to take this trade off, we're going to enter a closing order to close out this trade when the value goes up to 243. So again, it's going to be very similar to those debit spreads, but now you're basing it off of the current price, not the max potential gain. So I'm going to create a closing order. I'm going to type in here 243 to enter that automatic order. And again, we're going to change it to a GTC, hit confirm and send, and submit the order. So now that order is working in there as well. Again, it's going to get us out a 243 credit whenever the value of that calendar in SPY goes up to that price point. All right, so let's look at a couple more examples here. Let's look at some iron condors, which are very similar to credit spreads. So if we look at, for example, Chipotle in this example, we entered the Chipotle trade, which is a neutral iron condor, and we sold these iron condors for $1.25 each. Now this is a little bit different because now we're on the option selling side. So our max potential profit, since we sold this spread or this iron condor for $1.25, is the $1.25 that we took in. If we go back to our slides here and we go to the neutral section, you can see that if we're doing a balanced iron condor or just an even iron condor, that we want to take money off the table or take profits whenever the value or whenever we reach 50% of max profit. So again, since we're selling options, the value of the option has to go down for us to make money. So 50% of the 125 that we had sold means that we want to take this trade off when the value goes down to 62.50. Okay, that's our profit target on this trade. Right now it's trading at 125. That's what we sold it for. That's the max potential gain. Half of that gain, or 50% of that gain, is 625. So now when I go in to buy back this order to close, so right click on it and go to buy the iron condor to close. Now it's going to create a buy order, and I want to buy it back whenever the value goes down to, say, let's say $62. It's actually 62.5, but let's just say $62. And again, we're going to create this GTC order. So once I submit this, now this is going to be working in our position and activity statement. Again, you can see these different orders are now working for SPY, FXI, EWW. This Chipotle order is now going to buy this thing back whenever the value decays down to $62. Right now it's worth about $92.50. So we're making money on the Chipotle trade. We're making about $65 on this trade, but we need to make a little bit more money before we hit our profit target on this trade, meaning it's got to work just a little bit longer before we're comfortable taking this thing off for a big profit. Let's look at another example here with USO. Now in this case, USO is a iron condor in Thinkorswim, but if you actually notice, this trade and the way that we send it out to our members is an iron butterfly. And the reason it's an iron butterfly is because the short strikes, or the contracts that we sold, are at the same strike price. Okay, and again, if you sign up for a pro or elite membership, we always tell you if it's an iron butterfly or an iron condor, but Thinkorswim doesn't have a way to distinguish that it's an iron butterfly. They just tag it as an iron condor. So again, if we go back to our actual position statement here, and or our slides here, and take a look at where we take money off the table with a iron butterfly, you can see that a neutral trade, which is an iron butterfly, takes money off the table when we have 25% of the max potential profit, or when we've made 25% of max potential profit. So we go back here and we look at USO, you can see that we sold this iron butterfly in USO for $1.45. So if we take this trade off at 25% of that potential, or making 25% of that max credit, which is $1.45, we'd be looking to take the trade off at around 108. Okay, so a value of 108. Now you can see right now that that trade is already in our profit zone. So we could go in and actually close out this trade right now and remove the exposure and take profits. And that's exactly what we're going to do. I just wanted to do this on this video with you guys. So you can see it's already inside of our profit zone. If we had a working order or a closing order to get this thing off automatically, it would have been, submitted and filled at 108, but today it's actually come in now, and now it's around $99 of value. So we should make about $136, $135 by closing it out and buying it back for about $1. So we'll submit that order. It might get filled as we're kind of talking here on this video, but you can see that order is working right now. We're going to buy it back at about $1. It's worth about $99 right now. So we're paying a little bit more than market value, but since we sold the spread at 145, we should make some money on this trade as well. Okay. So hopefully that's a really good example of how we can use a lot of these contingent orders in our favor. Again, the key here is just remember that you have to buy back orders that you had originally sold. And if you bought options, you have to sell them to close out the trade, and that's really the key. But take your time with this. Make sure that you go through our when to exit guide. I think that's really key in understanding why we close out trades really early. These are going to be really easy to follow cheat sheets for you on bullish, bearish, and neutral trades to make it insanely easy for you to place these automatic closing orders. But remember, the more times that you can automate this process, the faster and faster you're going to be at increasing your win rate and increasing the potential profits that you have long term. So thank you so much for checking out this video. Hopefully it was really educational for you, helped you out and understand why we close out trades early, how you can do it on your end. If you have any comments or questions, please ask them in the comment section right below. If you love this video, thought it was helpful, please share it online, help spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.